What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. I had such a positive reaction from the TD quarterly earnings report that I figured I would do another one this morning on BMO. The most important thing right now is if you like these types of videos, I have absolutely no issues making them, but you got to drop a comment down below. Let me know you like them. Let me know you want to see more of them. You got to subscribe to the channel and like the video. If I see that people are liking these videos, I am going to continue doing them. And right before we get started, in the description below, you can grab a free stock report from us that contains 3 of my favorite options in 2024. But let's get started with BMO's quarter. And to be quite honest, it was, I don't really want to call it ugly, but it was borderline ugly. The stock is trading down around 5% at the time I am filming this. It's early morning right after they reported earnings. And you would think 5% isn't really all that much, but for a Canadian bank, a 5% drawdown is a significant drawdown post-earnings. These banks typically do not move that much in price. Now, BMO, they missed estimates on both the top and bottom line, so it was not a very good quarter. We have adjusted earnings per share of $2.64, whereas analysts were expecting around $2.75. Revenue came in at around $8.1 billion, where analysts were expecting $8.23 billion. But one of the biggest things for this, and I'll get into the provisions in a bit, was the company absolutely blew through provisions for credit loss expectations. So the company was expected to report around $745 million in provisions for credit losses. They ended up reporting $906 million. And the one alarming thing about this is, initially, analysts had expected the company to report provisions in the high $600 million range, and leading up to earnings, the estimates kept going higher and higher and higher, and BMO continued to blow through them this quarter. It was definitely a shock. Not a lot of people expected provisions to come in this high, and one of the main reasons they are coming in high is because its U.S. segment is struggling a lot. But let's dig into the quarter. I'm just going to mostly talk about each particular segment and then just go over some general numbers. So the efficiency ratio of 57.3, this is down on a year-over-year basis. The efficiency ratio for a bank simply takes its operating expenses and divides it by its total revenue. So it pretty much gives you an idea of, how management is handling costs in terms like that. So return on equity came in at 10.6%. This isn't bad, but this is declining on a year-over-year basis. And I guess I'll mention as well, we're seeing a lot of adjusted and reported numbers. All banks report this, but in the case of BMO, they made an acquisition of Bank of the West. They are a regional U.S. bank. This was a big acquisition last year. So their adjusted numbers are just adjusting, say, one-time acquisition costs out of this, things like that, pretty much to give you a better apples-to-apples perspective on the earnings that don't really contain any expenses that aren't going to be recurring in nature. So adjusted figures will be what analysts use to benchmark estimates. So, as we can see a reported earnings per share. This would be their GAAP earnings of $2.48. If you look at that estimate wise, it looks like they missed in a big way, but when you adjust them out, this is the figure they will use for expectations, $2.64, so they missed by 11 cents. So if we get into the actual quarter, which I'm going to go down to their overall financial results, again, we're going to use adjusted figures. Revenue pretty much flat year over year, which isn't the best because a lot of these banks are still continuing to grow revenue just because of higher interest margins, higher deposits, continued strength in that regard. Whereas most of the banks where they're struggling, not necessarily all of them, but some of them are on the net income side, and that is because of higher provisions. So typically you want to see revenue continuing to grow, and these banks can kind of weather the storm in terms of provisions over the short term. So BMO reported flat year-over-year growth and 3% quarter-over-quarter growth, which is some of the slowest growth out of the big 6 banks. And then when we look to net income, we can see an 8% decline year over year and a 3% decline quarter over quarter. And the bulk of it is going to be from these provisions for credit losses, which I am going to talk about later on. So CET1 ratio, again, I mentioned it in the TD video. This is pretty much the high quality capital that the bank has available in order to withstand, a financial shock, something like the financial crisis, let's say, even something like the COVID pandemic. It allows these banks to remain well capitalized so that they can survive something like this instead of, causing havoc. In terms of CET1, they have to maintain a minimum of 11.5. So BMO is well within this range. It's up around 70 basis points on the year, and it's down around 10 basis points quarter over quarter. So return on equity came in at 10.6%, which year over year is a 190 basis point decline. Not optimal. On a quarter over quarter basis, it fell 30 basis points. This is one of the weaker returns on equity among the big six banks over the last while, and you're going to notice a recurring feature when I am talking about BMO in this quarter, and that is the fact that it is one of the worst banks, the worst major banks in terms of performance over the last year. And as a result, its price is reflecting this. So the bulk of provisions are impaired loans, which are loans that are currently, they've witnessed some sort of non-payment. So a performing loan is a loan that is still being paid, but the bank has kind of figured, there's a good chance that this does become unpaid in the future. Whereas an impaired loan is a loan that has already witnessed some sort of non-payment or default. So we're looking at 828 million of the 906 million were impaired loans. So we can see the, adjusted net income trend here. We can see 1 year ago today, 2.1 billion in net income, and now we're down to 1.98. So not the best result from BMO. Most all of the banks are reporting some sort of flat to declining net income, but BMO's has been accelerated quite a bit. And as I mentioned, it's because of those PCLs. So if we dig into the Canadian arm, I want to talk about individual results here. So Canadian personal and commercial banking, and this is a segment that the bank is actually doing quite well in. When we look to adjusted revenue, it's up 9% year over year, 5% quarter over quarter. And when we look to actual net income, 920 million, it's up 3% on a year over year basis and 5% quarter over quarter. So return on equity, very strong in the Canadian segment. It's down 310 basis points year over year, but flat quarter over quarter. When we look to net interest margins, they're up 3 basis points year over year, down 3 basis points quarter over quarter. As I mentioned in the prior video, net interest margins are pretty much the gap between what the bank is earning on things like loans, issued loans, things like that, and what it has to pay out on deposits. And the company has kept their net interest margins relatively steady over the last while, which is a strong sign. So average loans up 6% year over year, 2% quarter over quarter, and average deposits up 11% year over year and 3% quarter over quarter. So provisions for credit losses are actually a bright spot in the Canadian end of things. So 388 million in PCLs on a year-over-year basis. This is a big bump, but as I've mentioned before, year-over-year provisions are not the best way to value these banks. The economy is in a much different state a year ago than it is today. So realistically, the best way to look at provisions is on a quarter-over-quarter basis. This is probably the most accurate figure because sequentially it's going to give you an idea of an acceleration or deceleration of provisions during relatively the same economic conditions. We're down 50 basis points in terms of interest rates in Canada right now, whereas last year at this point in time, we were very high. Provisions, were just starting to trickle in. The banks started, reporting much higher provisions, kind of playing a bit of a catch up due to the economic weakness. And we look on a quarter over quarter basis, the company actually reported $10 million less provisions than they did in the second quarter of 2024. So this is a good sign. You ultimately want this number to be lower on a year-over-year basis. And absolute best case scenario, you start to see a recovery of provisions for credit losses, but I think we're a long ways from that at this point in time. But for now, the Canadian PCLs, they seem pretty solid. Now, as I've mentioned before, the US segment is where this bank is really struggling right now, and it is no doubt weighing down on results. So adjusted revenue, flat year over year, up 3% quarter over quarter. But where the issue is right now is in net income, ultimately as a result of provisions for credit losses. So we're seeing a 9% decline year over year in terms of net income, and we're seeing a 12% decline on a quarter over quarter basis. And when we look to total provisions for credit losses, we can see 286 million, which is a year over year. It's more than doubled year over year, but it increased by nearly 30% on a quarter over quarter basis. When we look to the efficiency ratio, their U.S. Efficiency ratio is not as good. They are not as efficient of a business in the United States, and combine this with the higher provisions, ultimately, their U.S. arm is not performing very well. Net interest margins down 5 basis points year over year and down 3 basis points quarter over quarter. And when we look to net income trends in their U.S. arm for BMO, we see that, in Q4 of 2023, we're looking at 490 million. This is the fourth straight quarter of net income declines in their U.S. segment. And average loans and acceptances, we noticed in their Canadian arm, they were up, 6%. They're down 1% year over year, while their average deposits are up 4% year over year, whereas in the Canadian arm, they were up around 11%. So ultimately, their U.S. arm is not performing well. I would say it's one of the main drags on the business for sure. Now, when we get to I'm not going to speak much on the wealth management segment. It's performing quite well. Not good, not great, but not bad. Capital markets is doing quite well. That's mostly just because, we see global market revenue up 16%, primarily due to higher interest rates and equities trading revenue. I mean, it's not really surprising to see these types of banks report higher capital market revenue and higher net income when the markets are doing well, because it brings in equities trading revenue. It brings in, more underwriting, more things like that. And ultimately, the capital markets segment is going to be very cyclical based on, just the market trends overall. When we go down to the provisions for credit losses, this is the segment of the bank that is no doubt standing out right now. So when we look to the company's provisions for credit losses on an impaired basis and total PCLs, their total PCL ratio, so this will effectively take the bank's provisions for credit losses and compare it to its overall loans. So a company that has a PCL ratio of 1%, for every $100 in loans they have, $1 of those loans is a provision for credit loss. So we're seeing in Q3 of 2023, the PCL ratio on impaired loans, again, as I mentioned, are loans that, have witnessed some sort of non-payment. It sat at 21 basis points a year ago today, and fast forward to today, and we're sitting at 50 basis points. Now, as I mentioned, year over year is not the best way to look at it. You want to look at it sequentially. And the biggest trend here is we can see a steep increase in even sequential provisions for credit losses. I mean, even 1 quarter ago, we were looking at, 41 basis points, and it's jumped 9 basis points in a single quarter. And from Q1 to Q2, we're seeing 29 basis points to 41. So this is a trend that is certainly something to keep an eye on. And I mean, when we look to the bank's PCLs on impaired loans, I mean, they are going up, zero question. We're looking at provisions for credit losses in the business and government segment, 189 million just 2 quarters ago. Now we're looking at 518 million. The consumer side of things seems relatively stable. I mean, we're at 284 a couple quarters ago to 310, but overall, this chart is, it's upwards and to the right, and it is way more than many expected. When we look to the total PCL ratio, which is impaired, performing, things like that, we're looking at 30 basis points a year ago today to 54 basis points. So it's nearly doubled. And again, when we look on a sequential basis, we're seeing a 6 basis point increase, a 10 basis point increase, and ultimately investors probably do not like where this is going. I mean, when we check BMO share price again, I had mentioned earlier in the video, it's down 6%. This is a big move for a Canadian bank. So when we look to the gross impaired loans, now gross impaired loans are effectively the company's impaired loans and advances as a percentage of gross loans and advances. So service industry, one of the main struggles I could see in the economy right now would be restaurants. So it's not really all that surprising that they're seeing, a pretty big acceleration of impaired loans in that sector. Then we look at commercial real estate. Again, really not all that surprising. These two make up the bulk of the gross impaired loans, especially on the commercial real estate side in the United States. Now, gross impaired loans as their gross impaired loan ratio sits at 89 basis points, which again, if you look on a sequential basis, I mean, it's just accelerating quarter after quarter after quarter, which, ultimately a lot of people probably want to see a bit of stabilization in this situation, which we're just not seeing with BMO. Every single quarter, it seems to be reporting a surprise in terms of just overall provisions, impaired loans, things like that. When we looked at the company on a valuation basis, it's trading at 13.8x earnings, which is a significant premium to its 5-year median averages and its 10-year median averages. Now, on a price to book value, this bank is effectively, it's trading at close to book value. And this is a pretty large discount relative to its historical averages. However, it's really not all that surprising that the market is valuing this company with a lower book multiple, considering all of the provisions they're having right now and the acceleration of those provisions, the continued acceleration. Whereas, you're seeing a bank like, they haven't reported yet, but CIBC's provisions are very much normalizing right now, and as a result, they've cruised in terms of share price over the last while, whereas BMO is still witnessing those provisions accelerating. And as we look now in terms of total share price return, when we look to returns from March of 2024, March of 2022, when it hit that peak, I mean, they really haven't done all that much. I mean, we're looking at 7% total return, whereas the TSX index has returned 25% and the S&P 500 has returned probably much more than this, 31%. So BMO has been quite the laggard over the last while. It's not surprising you see right here in late December of 2023, it was keeping pace with the indexes until it started reporting soft results, and the market is effectively, just lowering the price it's willing to pay for BMO right now. Now, another question investors are going to have is the coverage of the dividend. So when we look to year-to-date 2024, we can see a adjusted earnings per share of $7.78. And when we look to the actual dividend of Bank of Montreal, we can see it pays around $1.55 every single quarter. So on a dividend basis, it's well covered. I mean, you're looking at $3.10 in terms of dividend payments, and the company reported adjusted earnings of $7.78. So on that front, the dividend is well covered. It still makes up, less than 50% of earnings. However, it's ultimately the growth and the concerns about those accelerated provisions that have resulted in BMO struggling quite a bit. Now, I know probably one of the main questions that investors are going to ask is BMO a buy right now? Full disclosure, I sold BMO after they started to report, a soft quarter or two. I believe I sold it. It was probably 3 quarters ago. So do I think it's a buy right now? Obviously not. I sold it, so that should be pretty clear from that front. It would be a little weird if I sold my position, 6-9 months ago and said it was a buy today. I believe there are better financial institutions here in Canada. My banking positions consist of Royal, National, and Equitable Bank, and they are likely to stay that way for the foreseeable future. Could the company rebound if provisions start to normalize? Certainly. I would expect that price to book multiple to probably expand. When we look to a forward earnings basis, 9.8x earnings is not all that much, so it's not that expensive from that basis, but banks tend to trade in line with their historical price to earnings ratios. They remain relatively, in line with these ratios. So it's trading at a premium right now, which it's very hard to predict, but ultimately it could mean more downside over the short term, especially if it continues to report soft quarters. So everybody, I hope you liked the video. Again, let me know in the comments if you want to see more videos like this. I have absolutely no problem making them. I'm doing these earnings reviews all the time, but you got to let me know in the comments. You got to support the channel, subscribe to the channel, like the video. That way I know you like it, and I will push more of these out more often. As always, everybody, stay tuned for more great Canadian content, and we'll see you next time.